Good morning, Ken. How are you?
I'm doing well. How are you, Gina?
Good. Thank you so much for joining me.
Absolutely.
Yeah, I know you have a lot going on in Florida right now, so I appreciate the time just to hop on a Facebook Live with me. I appreciate it.
Sure. Absolutely. Yeah, happy to be here.
Yeah, and for everyone watching, thank you so much for joining us as well. Today, Ken and I will be discussing a new topic. It's IRS announcing new 401k and IRA limits. Ken, can you give me a little input on that?
Yeah, absolutely. So last month, the IRS did that announcement, as they do every year, sometimes a little later, but they have increased some of the limits that were imposed on the 401ks as well as the 403bs, 457 plans. And so what that means is that individuals in a 401k environment last year could put in $22,500. They upped that this year to $22,500. So if you do the math on that, it's just short of a 10% increase, which obviously part of the theme we'll talk about today is the inflation and how things cost more. And so this is I think a result of that. The 401ks have increased, so that's a welcome addition there to retirement savers and their ability to be able to do that. At least it's increased, and so the catch-up provision as well. So what is a catch-up provision? Well, that's someone who is 50 years or over. Then they can add to that base amount. So said differently, someone less than 50 years of age, then their limit is this year going to be up to $22,500. But the catch-up provision is increased by $7,500. So that's a 15% increase over last year's $6,500. So someone over 50, again, with a 401k, 403b, 457 type plans, they can put another $7,500 in with that $22,500. So that total is $30,000 into the retirement plan.
And for any changes for and Roth IRA?
Yeah. So again, that is the base IRA. All right. Yeah. The Roth IRA then also had an increase, but not quite as kind. It went from $6,000 to $6,500, or about an 8% increase. And the catch-up provision is the same. There was no COLA or cost of living adjustment to that. So it remains the same. $1,000 is the catch-up provision. So there you have it. It's the IRA was a bit kinder. Of course, that's tax deferred money. So that's figure out the tax later on. And then, of course, the Roth IRA is one of our all-time favorites at our firm, simply because that is tax free and that has a great ring to it. So we like that kind of strategy.
Yeah, absolutely. So, Ken, what are the highlights of these changes?
Yeah, so I'm just going to add a little bit of flavor to the commentary then on the Roth and the IRA. There is a phase out that everyone should be aware of. Mm-hmm. All right, so that is an income phase out, and that's pretty germane to the way that that Uncle Sam or the IRS is going to limit the amount of money that you put in. So in 2022, for a single, or the complementary to a single is going to be a head of household. That type of a person in 2022 would phase out between 129 and 144,000. So that means that they would not have those same opportunities there. Now in 2023, that's increased to 138,000 to 153. Mm-hmm. So as I begin to describe this, of course, it's important that we understand you want to talk to your tax advisors about this and how it affects you and how you might be able to put together a strategy. These are just the limits that have increased for next year. And the next thing about that is the marrieds for 2022. They had 204,000, 214,000, and that has been up to 218 to 228. All right, so that's what the phase outs are there. Personally, I would hope those numbers would have gotten a whole lot larger. Yeah. For someone to be able to make their contributions not only to the IRA, but also my all-time favorite, the Roth IRA.
Right.
Right. So that's kind of what was announced with the IRS and the new limits on contributions and that kind of thing.
So why did IRS raise the contribution limits?
Well, inflation was a key thing. There's no question about that. The key is the inflation. There's this whole theme of relief, and now typically there's going to be a cost of living adjustment each and every year. That is pretty much going to happen each year. We know that most of the time it's much smaller than this, but these numbers this year are really all-time high numbers.
Yeah.
These are record-breaking numbers, both in amounts and percentages.
Mm-hmm.
Now, let me kind of add a little bit of context in the financial planning and the tax planning side of it. Again, talk to the tax advisors about this. But the thing about eligibility is that you could be phased out, as I mentioned there. So, and what I'm talking about here being phased out is I'm talking about the ability to contribute to an IRA and have that contribution be deductible. All right, under your tax. So that's kind of a strategy we have is that if I put money into an IRA, then I can take that off of my income for that year. Mm-hmm. And so the bigger the amount, then the bigger the impact on the tax saving. And we're going to be looking for every little way we can to be able to adjust tax for sure. So again, number one, we're talking about the ability to deduct the IRA contribution. And then the other really is the ability to contribute to a Roth IRA. Now, remember, you don't get any deduction for a Roth IRA. When you put the money in, there's no deduction for it, but then it grows tax-free. Mm-hmm. And so the theory there is that taxes will be higher in the future. So therefore, that would be a significant benefit. And I subscribe to that. As a planner, I think that's pretty much a given. That's pretty much a known. We know that's going to continue to happen. So now, here are the things about it, though, that it's a little bit of a complication, and that's why you want to talk to tax people about this, is that if either spouse is covered by a company plan, then depending on income and filing status, you could be phased out. Oh, right. So what you're learning about today is that these are possibilities, but then, of course, Uncle Sam likes to close those loopholes. So if you're covered under a company plan, then you may be phased out due to income and filing status. So that's why I wanted to have the conversation, about that, and remind you that you need to get more information. These are some good generalities here, and so there you have it. I can go a little bit more into the phase out, but I don't want to make it too complicated. I just want folks to understand that you can get phased out on that. So for a single taxpayer, as an example, if you're covered under a company plan, your phase out this year is going to go up to $83,000, from $73,000 to $83,000. Okay, so that's the phase out income limit if you're covered under a plan. Okay, now married couples, that phase out is going to be $116,000 to $136,000. That's if you're both covered. All right, and that's the income phase outs. And so be mindful of that. Make sure you're having that conversation with your tax advisor. Now, here's the rub on tax advice, is that typically we talk to tax advisors when we're filing our tax returns, right? And this is a conversation you want to have with your tax advisor or your financial planner before the end of the year to see where you stand on things, and then set yourself up for next year, as an example. Okay, so there's that. And one other piece, there is a bit of a wrinkle when one of the spouses is covered. All right, so just know that if one of the spouses is covered, then that phase out range increases, and significantly, $218,000 to $228,000. All right, so I'll leave it at that. Enough complication there, but those are the limits, and that's how Uncle Sam kind of moderates the ability to plug a lot of money in there. Is that they phase you out by income. All right.
All right. Thank you for so much for explaining that. Are there any that we can expect to see in 2023?
Yeah, so as I mentioned a little bit earlier, this is the largest increase ever. Right. So, and of course, on the heels of that, I think we need to recognize that inflation is at the highest numbers ever as well. I mean, these these are extraordinary numbers. I think the number back in September was 8.2%. And so I'll just, just kind of use that as a basis for it. So the idea that we're getting these contribution limits is help. Yeah. But, my gosh, everything costs so much. So, right behind that, people will ask me, well, I can't afford to put that much more in there because everything costs more, at the grocery store, at the gas pump, or, you name it. And so I get that it is. But, as part of the strategy, there are multiple ways to take a look at this. The IRS did also announce some higher income tax brackets. And the reason why I bring that up is that as income increases and the limits increase, what you want to do is you want to have those income brackets go up just to kind of keep pace, if you will. They call it kind of a bracket creep, if you will. If the brackets stay the same, the more income, then you get in higher brackets. So we want to try to avoid that. And so there you have it. It's really the bracket increases also will be helpful, I think, to many taxpayers out there. And so then moving on really to some of the new changes for this year as well, the standard deduction itself is one of the things that most people are going to be very interested in. And, if not most, all people should be interested in that because it has increased then this year and it goes up to $27,700. All right. So that's the base for standard deduction for a married couple. Okay. Now, the marginal tax brackets for last year, for 2023, I mean to say, it still remains at 37%, right? So that hasn't really changed. And that's for the incomes that are greater than $578,000. All right. And married filing joint returns and filing jointly $693,000. That's a top bracket. There's 35% bracket, 32% bracket, the 24% bracket, the 22, the 12, and the 10. So they're all still intact for those brackets. And so again, just getting down into the 12s and the 22s. The 22 will be as high as almost $90,000 for a married filing a joint return. Okay, the 24 bracket married filing a joint is about $190,000. So that covers a pretty good hunk of people out there that can kind of see where their brackets are at. The key thing, of course, is when you jump from that 12 bracket to the 22 bracket, that's a pretty big increase, almost a doubling of the tax itself. So again, why we want to take a look at tax strategies there. Something else that's changed for 2023 is the alternative minimum tax exemption. That has been increased. So the AMT, or alternative minimum tax, another conversation you want to have with the tax professional, your financial guy, simply because many people can be affected by the AMT tax. That's gone up to $81,300. All right. So then for some others, then another nice change is the earned income credit. That's been increased to $7,430. That's for qualifying taxpayers. Of course, that's lower income, but it's an earned income credit, and need to qualify for that, and so on. One other note I think that would be helpful for some of the retirees and those that have significantly more wealth. They like to give money, so that's called an annual exclusion of gift tax. All right, so that's increased this year to $17,000. So what do we mean by that? That means that you can give to anyone you want to, you and your spouse can, and not pay any tax on that gift on that. And of course, if you do want to give away more than that, there are other strategies associated with that. But this is the given. This is the gimme that the IRS gives you.
Boy, there's a lot of changes coming, huh?
Well, what I would say about that is taxes are complicated.
Yeah.
My comment always has been that when you're doing taxes, it seems like it's easy to do because you just plug all the information in and you send off your check, or you file a return. The key thing is that you have a strategy to minimize legally, ethically, honestly, the ability to be able to lower the taxes. And I'll touch on one strategy I think that sometimes gets overlooked in this environment, And what I mean by that is that there is a provision, and these tax laws, really, the base of these tax laws were put into place in 2018 under the Tax and Jobs Act. So that was a Trump administration that authored that. And part of what happened is that we have the ability, since the personal income, the personal exemption, that personal exemption is fixed and it remains kind of the same. It's zero. Okay. And so now what happens is that we have the ability to have an unlimited amount of itemized deductions. All right. So, and that's an important factor is that, again, the amount this year is somewhere around $27,700. So if you have itemized deduction, medical costs, qualifying personal exemptions, talk to your tax person about that, financial about that, and get some idea of what you're eligible to do. But to be able to maximize that is another one of the key strategies, I think, is to be able to write off as much stuff as you can that qualifies to lower your income. And there is no limit to that. Of course, they have to be qualified and all of that. So there again, there is no limitation on itemized deductions, and that is followed through since 2018. So it remains in place for 2023.
So Ken, question for you. Can the election results, can that vary the tax policies and economy moving forward?
Oh, yeah. Look, my position on taxes, they're going to go up. And my position generally is it doesn't really matter who's in office, the taxes have to go up. So whoever's in the White House, we're going to have higher taxes. Mm-hmm. The rub, I think, is how much higher and who's going to pay the tax.
Right.
All right. Now, I think that you're going to find they're going to go after the taxes with the people that have the money, right? So it's just one of those knowns out there. So I want to reiterate that. So if you have wealth, if you have lots of money in IRA accounts and retirement plan accounts, that is a target. Why? Because the government owns the rules on that. If it's been in a company-sponsored plan, then remember, the company owns that plan and you're a plan participant. Mm-hmm. All right. In an IRA, you own it. All right. So there's a little bit more latitude in what you do with the money. And so there again is a couple perspectives to have in place. But I think taxes are going to go up. It depends on where they're going to go after the taxes. Here's another universal truth, I think, that everyone would recognize, and that is that we had another very nice increase on Social Security. So for those retirees, they saw Social Security jump by 8.7% this year. So that's something to celebrate.
Yes.
For sure. Now, the rub on that, of course, is the more income you have, including Social Security, pensions, money that you take out of your retirement plans and so on, that will increase your Medicare premium. And that's something that we don't recognize until we get into retirement and get on Medicare, which, of course, is being deducted from your paycheck every single time you get paid. Mm-hmm. All right. Just like Social Security, every time you get paid, you contribute to Social Security. So that's a tax, right? And then you're being taxed when it comes out. And the rub that I have for that is that they have not ever made a cost of living adjustment to how much is being taxed. The married person is being taxed between $32,000 and $44,000 of income. Okay, and it brings that Social Security into up to 85% of Social Security is being taxed at that level. Mm-hmm. It is since the 1980s. Okay, that's a long time ago, and they haven't increased that. So what it really does is it guarantees that there's a double tax on the Social Security. You're taxed when it was taken out, and then of course you're taxed when you get the increase. So that 8.7% is happy days for many, many people. But you have to be in low income brackets in order for that to be a good net effect to you. And for most of us, with these increases and the increase in more additional income necessary to just maintain our standard of living, and those Medicare premiums go up as well. So not to end on a sour note, but those are the realities of what's going on. So again, I emphasize, talk to the tax people about this. And put yourself in a position to where you're aware of how you can legally and ethically lower your taxes and get a strategy together. And then you'll have I think a more even keeled result on the back end. Get more money in your pocket.
Absolutely. And everyone, as Ken mentioned numerous times, please consult a tax advisor to discuss tax implications. So, Ken, thank you so much for taking the time again and joining me on a Facebook Live.
Absolutely. Glad to be here.
Yeah, I appreciate it. And everyone, thank you so much for watching. Please make sure to comment, like, and share this video. Share the education. Ken, until next time, we'll see you soon.
Bye for now.
Okay.